Good morning and welcome to today's webinar. It's all about sealing the deal, an in-house counsel's guide to streamlining corporate transactions. Today's hosts are myself, David Kerr, practice leader in our corporate team, and I'm joined by Tom Linnane, one of the lawyers here at LegalVision. Before we begin, just a couple of housekeeping items. You will receive a copy of the recording and the slides in your email. You'll be able to submit any questions you have about the webinar in the chat box. We'll get to those at the end. And there'll be a short feedback survey at the end of the webinar. Everyone who participates in today's webinar is eligible to receive a call from our enterprise team to discuss how we can assist you with your everyday business legal needs. In order to be able to book the call, please leave your contact details in the survey at the end of the webinar. So today's presentation will be mainly focused on the buyer's perspective in corporate transactions. However, many of the topics we do discuss are relevant to sellers as well. We'll be looking at business structures and how you evaluate the impacts of the structure from both a corporate and tax perspective. We'll look at the corporate record keeping and what to look out for in due diligence, or what you can prepare for if you're a seller. We'll discuss some of the tax-specific items. We'll look at how warranties and indemnities are used in transactions. We'll give you a better understanding of the supplier of a going concern. We'll also talk about some of the key things to look out for in customer contract reviews, and then we'll deal with all the questions at the end. So one of the first elements to really think about when you're about to undergo a corporate transaction is the overall structure of the group. The group structure really impacts both the financial position of the company or the group, it also impacts the tax, and it really determines how complex the deal documents have to be from a structural perspective. Some companies are structured well in a relation where you have an ultimate holding company and subsidiaries underneath, but very often companies are structured where there's related entities who aren't within the same corporate group. They may have common shareholders, one may be held through a particular founder or shareholders holding, and other things through their personal trusts. And the interrelationship between those entities really affects the way that the acquisition needs to occur. When you're setting out looking at a deal, you can structure it to be a share sale where you just acquire a entity or particular entities, or you can look at it whether you're purchasing assets. To be able to do this, you really need to understand the corporate structure of the group and the way that all of the companies and entities within that group, even if they're not technically a legal group yet, and whether that is the ultimate structure and the most efficient structure for the deal moving forward. You want to understand in due diligence what the structure looks like, who are the owners of each entities, what sits in each entity, whether certain entities are trading or they're just used to hold certain assets. Are they designed to protect from an asset protection point of view, or were they set up to make it more tax efficient? When you get an understanding of that, you'll be able to understand whether moving forward, how that fits into your group structure and whether you need any of those entity elements to stay around, or whether you can simplify the structure by only taking certain assets and putting them in your current entities. Now, the main reason why you want to do this, it simplifies the deal structure, it enhances hopefully your tax elements, and therefore it speeds up the deal and reduces costs. So if we head over to the next slide, I'll pass on to Tom and he can explain to you some of the tax elements.
Great, thank you, David. So as David mentioned at the start, we are primarily focusing on the buyer in a corporate transaction today. However, we'd be remiss if we didn't at least touch on some of the tax implications that can arise for the seller during a corporate transaction. And so we do really recommend that the sellers do get advice on the structure of the deal and the tax implications for them, because there are a number of concessions and implications that are available for a seller in a corporate transaction. And what these concessions are and what implications arise really come down to A, the business structure, but also B, how the deal itself is structured, because both of these things will impact and determine who the actual taxpayer is in the transaction. So say, for example, in your business sale, potentially it's the company or the business owner that's the taxpayer, but in a share sale, it's going to be the shareholders. And there are certain concessions and discounts, especially in the capital gains tax space, that aren't available for all taxpayers. And a big example is the general 50% CGT discount that isn't available to companies but is available to individuals and trusts. So that's something in particular that we would recommend getting advice on, but something else as well is considering whether the relevant taxpayer has any capital losses either from the same income year or from previous years that could be used and applied towards reducing any capital gain that does arise as a result of the particular sale, because that might be a way of getting the tax liability down before any concessions actually need to be applied. And then based on what comes out of the due diligence process, potentially the purchase price might need to be adjusted because the buyer might want to negotiate it down because of what they find during the due diligence stage, but also thinking about the purchase price itself and what this comprises of. So is it all cash? Is it potentially a scrip for scrip sale, so receiving shares in exchange for other shares, or is it a combination of both? So all of this is going to be relevant for a seller when going through these types of transactions, because there are just different tax outcomes depending on the result of those discussions. But on the next slide, we've considered some more general points, especially for the buyer within a deal, within a transaction. And a big one to consider is the stamp duty implications of being the purchaser of a business or even shares in a company, and it really comes down to the state or territory in which the deal is taking place in, because each state and territory has different laws when it comes to stamp duty, and so it's important that you get advice in the relevant jurisdiction. So for example, in New South Wales, stamp duty was abolished on business sales in around 2016, whereas Queensland still has stamp duty on the sale of a business asset. So that's something the buyer will really need to consider at the beginning of a transaction, because there are different requirements around timing for stamping documents, but also just making sure that they have the cash available to actually pay any stamp duty when that liability arises. And then if your client is a foreign buyer, there can be certain elections that are required to be made to the ATO, particularly where the target entity has an interest in real property. So those are the types of things to think about when at the beginning of a transaction when acting for a buyer in a corporate transaction. But I'll pass back to David, who's going to talk about record keeping and the due diligence process.
Thanks, Tom. Corporate record keeping is something that not only is important to the buyer conducting legal due diligence, but it's also something that sellers really need to consider getting ahead of and having prepared if they are the target of an acquisition. Corporate record keeping does a few things. It sets really the standard and the level of comfort that a potential purchaser has in your corporate operations. Now, legally, companies need to ensure that they've approved transactions, and the way that that is done is through corporate record keeping. They come in the form of approvals, and they also come in the form of the actual documents. We often see that a lot of the time, documentation between corporate entities seems to be lacking, and that is mostly because often businesses are more focused on supplier contracts and customer contracts and forget about the inter-party relationships. But if you are undergoing due diligence, you want to be able to verify all shares that have been issued or acquired. You want to make sure the assets have been correctly documented in the right entities, whether that was through a previous acquisition, whether that's through contractual acquisitions from customers, whether that's through creation of IP, When you're licensing out your IP, if you're using a corporate structure and there's various entities, ensuring those other trading entities actually have a license to use the IP held by your operating companies. Also, within those documents, making sure that you assess the level of liability and guarantee within the entities. Certain entities will cross-guarantee other entities. You can have directors who are required to guarantee certain elements. There can be other financial guarantees like bank guarantees in leases and lock-up amounts in escrow for large contracts. Understanding that, whether you're the seller and be able to put that succinctly into a data room so that you look well prepared and sophisticated, increasing confidence for the buyer, or whether you are the buyer trying to gain confidence that you know what level of documentation and how sophisticated the organisation is really important. It will be essential in the transaction documents. If you aren't able to gain a level of confidence through doing the documentary due diligence, then it's more likely that you will need specific indemnities and warranties to protect you. If we head over to the next slide. As I was discussing, intercompany transactions really do play an important role within your organisation and their documentations. Often companies lend money to each other, whether those companies are part of the same group or whether they're related entities through common shareholders. The way that these loans are documented and the conditions that are put upon them are not only impacted at corporate approvals level, but they do have tax impacts in terms of what needs to be charged between the entities. Where security is granted, ensuring the entities which have provided the securities, understanding what their security requirements are, what default events might happen in terms of change of controls and moving of assets, what restrictions you have on further debts, and getting an understanding of that is really important from a buyer's perspective. It will help you determine whether you need to arrange for certain loans to be extinguished, if there's an intention of a restructure, because you don't need the current corporate group you're acquiring. Understanding these intercompany loans and security arrangements are really important. If they're not documented and otherwise easily identifiable, as a seller, purchasers aren't going to be able to have comfort that the transaction price mostly is going to be well, or they're going to want other guarantees and protections in the contract. So outside of the legal risk, as a seller, it's really important to focus on getting these things in order. As a buyer, if they aren't in order, asking sellers to ratify decisions and document pre-existing oral contracts is really important. It's important for both the clarity perspective and to ensure that the legal process is efficiently able to proceed. I'll hand back to you now, Tom.
Great, thank you, David. So just like corporate due diligence, tax due diligence is super important when going through an M&A deal. And your tax due diligence is really going to inform what warranties and indemnities you're going to ask for from the seller. And that will also be informed by, the due diligence process will be informed by whether or not it's an asset sale or a share sale. And usually with the latter, you're going to be doing a lot more heavy lifting when it comes to the due diligence process, because you're taking on all of the historical liabilities of that company, including any potential tax issues. So a big thing to look for when doing either an asset or a share purchase is considering whether or not the target has employees or contractors, and if so, considering whether, or doing due diligence on whether that particular target has been compliant with its employment tax obligations. So things like pay-as-you-go withholding, superannuation, fringe benefits tax, and payroll tax as well at the state and territory level. So when it comes to unpaid pay-as-you-go withholding and superannuation amounts in particular, both of those liabilities can attract what's called director penalty notices when the ATO can make a director liable for historical unpaid super and pay-to-go withholding amounts. And that can include where a new director has come on board and despite not being around at the time when those were potentially incurred. So that's a big thing to look for when doing your due diligence. And another one in particular is where that entity has contractors, particularly if it has a lot of contractors that it's used for a long time. Asking whether or not that entity has ever gotten advice around, are those contractors genuine contractors, or are they employees for pay-as-you-go withholding and or superannuation purposes? And if it's the latter case, that they could be considered employees for either of those purposes, have the relevant obligations been satisfied? So has pay-as-you-go withholding been remitted to the ATO? Has superannuation contributions been made to the contractor's nominated superannuation fund or a stapled fund? So those types of things are super important, especially because a big focus area of the ATO at the moment is employment taxes, and there are a lot of situations where contractors can be captured by the definition of employee for tax purposes. So it's important that those questions are asked during the due diligence process. Beyond employment taxes, looking at the other lodgements of the company, so checking whether they're up to date and whether the actual liabilities have been paid. So big one is income tax, goods and services tax, payroll tax, and any other indirect taxes that might be relevant to the industry that the entity operates in. So if it's an alcohol business, questioning whether or not it's liable for wine equalisation tax. If it's in the car business, does it have to pay luxury car tax, those types of things. So it's important that those questions are asked because, again, indirect taxes are also taxes which can attract director penalty notices if they haven't been complied with. So those are big questions to be asking during the DD process. So during the due diligence process, this could also reveal other financial information about the business. So if there's a number of unpaid liabilities or whatnot, then that would obviously impact from a cash flow perspective. So these are all things that could go into the negotiations of the purchase price, and potentially as a buyer, you would use that as leverage to try and adjust it to deal with the fact that these liabilities might have to be dealt with. So moving on to the next slide, we've put some specific questions that should be asked when going through a share sale for the tax due diligence process. So as mentioned previously, a big one has have all lodgements been submitted and have all the amounts under those lodgements actually been paid. If it's a company with an employee share scheme or an employee share option plan, has the company been complying with its ATO reporting requirements for that employee share scheme, which is usually giving statements to both the ATO and the employee, and when those are due depends on what type of employee share scheme they have, and the ATO can impose administrative penalties if those haven't been complied with. So also asking what audits have been undertaken on the target in the past, both at the ATO level, but also at the state and territory level, and what was the result of those audits or any ongoing, that kind of thing. Have any voluntary disclosures been made to the ATO where the company has made a disclosure about potentially a mistake in its previous tax affairs? Have any private binding rulings been applied for from the ATO? And if so, what scheme does that relate to? Is that scheme still going? Because that might impact the day-to-day business operations. What is the structure of the business, and has it gone through a restructure in the past? So for example, did it start as a single company structure and move to a dual company structure later? And if so, what advice was obtained at the time? What documents were put in place to make sure that it was all actually done above board from a tax perspective? Does the business operate in multiple jurisdictions across the world? So is it a multinational business? If so, has sales tax been considered in the other jurisdictions that it sells either goods or services in, and have those been complied with, and are they up to date? And is there an entity in another country as part of the corporate group, whether that's a holding company or a subsidiary? And are there any dealings between the Australian company and the overseas company? The reason why that's important is because related party transactions that are cross-border have to comply with the transfer pricing rules, which is basically that any transactions have to be on an arm's length basis. So have those rules been complied with, and what documentation is actually in place to show that that's all been happening? And then finally, making sure that you're reviewing all of the financials of the particular company, so its balance sheet, its profit and loss statement, because that'll give you a really good understanding of the current liabilities and assets that are on the books of this particular company, which will again go back into negotiations around the purchase price and that kind of thing. And so how far you actually look back on any of these questions will really depend on the particular company and the industry that it operates in. So it's important to turn your mind to that. So when going through, if we just move to the next slide, the other warranties and indemnity considerations are really going to depend on who you are in the transaction and what you find during the due diligence process. So if you're the buyer and the due diligence process hasn't shown everything you'd like to show around the tax position of the company, then those warranties and indemnities are going to be super important to give you some level of comfort that there would be recourse if there's a skeleton in the tax closet that comes out down the line. And when it comes to the timing of those warranties and indemnities, of course, you'd want them to operate for as long as possible. However, you want to be able to negotiate that they are applicable for at least the amendment period for that particular entity, which can differ depending on the size and structure of the entity. And then on the next slide, I've just put some other practical tips for warranties from a tax perspective. So if there's a high risk of there being an unpaid tax liability that will need to be dealt with, potentially asking that a percentage of the purchase price is held in escrow until that liability has actually been dealt with. Again, if it's a multinational structure, is there a potential tax liability or claim in that other country, and has that been dealt with? When drafting the indemnity itself, it should not only cover any potential tax shortfall, but any penalties, any interest, and any associated legal costs with enforcing that indemnity or for a breach of the warranty. And then if you're buying a subsidiary, which is a part of a tax consolidated group, there are often tax implications for the holding company and professional costs associated with removing that particular subsidiary from that consolidated group. So discussion should be had around, okay, who's going to be up for the cost of doing the allocatable cost amount calculation, and whether there needs to be some kind of adjustment to the purchase price for the tax that the holding company might have to pay for selling that subsidiary. And then finally, for the practical tips, if completion is going to straddle to lodgement periods, so 2 financial years for income tax or potentially 2 reporting periods for fringe benefits tax as an example, who's going to be responsible for the lodgement of the relevant return and who's going to benefit from any either return or say R&D refunds or whatnot that might come about after completion. So then if we move to the next slide, we want to discuss what's actually involved in considering if an asset sale is a supply of going concern. And so what a supply of going concern is, it's a provision that allows an asset sale to happen GST free. And so this is relevant for both parties in a transaction. So if you're a seller, if it's not GST free, you'll have to add GST to the purchase price and then remit it to the ATO. And then if you're a buyer, if the sale isn't GST free, then that's potentially a cash flow issue that you'll have to consider as part of preparing for completion, because if there's GST that's added, that's more money that you might have to come up with, even though from a cash flow perspective in the wash, you'll eventually get that GST back when you lodge your next business activity statement, but in the short term, it can still have cash flow impacts. So the first step in determining whether an asset sale is a supply of going concern is, does it include everything necessary for the continued operation of the business, and is the business going to be continued on by the seller until the day of sale? So particularly around whether or not a sale includes everything necessary for the continued operation of the business, this has been considered by the ATO in a fair bit of detail, so definitely would recommend getting advice where it's not abundantly clear that everything necessary for the continued operation is actually being sold as part of the deal. And then the next step that you have to consider is whether or not the supply of going concern is actually GST free, which involves asking, is the supply for consideration? So is there a purchase price? is the buyer registered or required to be registered for GST? And then finally, have the seller and the buyer agreed in the relevant transaction documents or somewhere else in writing that it is going to be a supply of going concern. So if all of that is satisfied, it should be a supply of going concern and should be GST free. So it can be super easy in these types of deals to just assume that a business sale is going to be a supply of going concern, but it is super important that the parties and their counsel turn their mind to this point in particular, because it's just not always the case in all business sales. So an example in a recent transaction that I worked on is where there was a buyer, an international company purchaser, who wasn't registered and wasn't required to be registered for GST. So in that case, it automatically didn't meet one of the requirements and therefore wasn't a supply of going concern. So just noting that if it's not a supply of going concern, that isn't the end of the discussion, because the deal still might be GST free under a different provision of the GST Act. So in the example I just used, we looked into it, and in the end, it did end up being GST free under a different provision, section 38.190, which is about making a supply to an overseas or non-resident where the enjoyment of the supply happens outside of Australia. So if that's the case, it still had the same outcome, that it was GST free. However, if the transaction documents had still said that it was a supply of going concern, that would have just been factually incorrect. So it's still super important that the parties do consider the supply of going concern provision. And if in all of these investigations, for whatever reason, if it does need to be a taxable supply, so GST is applicable, the seller would need to add GST or pay a portion of the purchase price if it's GST inclusive to the ATO. And for the buyer, again, it's that cash flow issue of GST is being added, but noting that in the end, they will probably get that GST back in their next business activity statement. But a big thing to consider whenever it comes to GST generally is the seller actually registered or required to be registered for GST? So looking at all of the facts, if for whatever reason that the GST turnover isn't high enough, even with the sale of the business, potentially the seller might not need to be registered for GST, in which case it wouldn't, the GST provisions wouldn't matter at all, and there'd be no need to consider it further, but definitely would recommend getting advice on that provision. So that's all from me. I'll pass back to David, who'll finish up with talking about reviewing customer contracts.
Thanks very much, Tom. I guess one of the key elements of any business is the customer contracts. Most of the commercial discussions and preparation for understanding purchase price will be tied to the state of affairs with respect to the company's customer contracts. One of the most important clause that you will see in customer contracts when it comes to a business sale is the change of control provisions or consent requirements when there's an assignment. Whether or not you have decided you need a share sale, an asset sale, or a combination of the two, any change of control provisions or consents required on assignment will be triggered. Now, how that is dealt with really depends on the terms of the contract. You need to identify what the specific clause says. Is it merely a notification requirement where the seller needs to notify customers that a change of control is happening or that the contracts are being assigned, or is it more that you need acknowledgement in writing? What are the consequences if you don't receive that acknowledgement? Can they terminate? Another thing to understand is which contracts, if you're doing an asset sale, really need to be novated or assigned. Are they key to the business? Is there a supplier that without their supply, there's a threat to the supply chain and your ability to conduct the business post-transaction will be affected? Or do you have your own supplier where it's not a material issue for the business? One of the key considerations also around change of controls and notice for assignment is licensed businesses. It's really important to remember that licensed businesses also very often require notification to the licensing body. Some of those are limited in industries where it's just a notification, and then the regulating body can do an audit post-transaction to see if you as the buyer are adequately suitable. Other times you'll need to actually go through the application again as the buyer. Where you need to go through the application again, and that license is essential to the operations of the business, and you don't have a license yourself that allows you to conduct the business without the seller's license, then you really need to consider, is it something that is only a small element of the business and you can deal with by way of a reduction to the purchase price, or is this something that we need to include in transactions documents to say this is a condition of sale? If the approval isn't granted, then we don't proceed with the sale. Not limited to customer contracts and licenses. Leases often have these clauses. If your business has premises which it do not own and they're leasing premises which are essential activities, whether there's a asset sale or share sale, very often leases will be triggered in a way that the landlord effectively asks you to re-go through the application process, even if it's a change of control. Now, while these may not be rejected, it's just important to think about these things ahead of time and in due diligence plan out the deal flow, because very often parties agree contracts, they start moving through the process, and then it comes up to nearing the target completion date and steps haven't been taken. Government agencies are slow to act, landlords not incentivized to act as fast as you are as the purchaser or the seller, and transaction completions are delayed. So having a good preparation process in a corporate transaction, or if you're a seller, having these things prepared, giving the buyer comfort that you're aware of these things, you disclose them, you let them know what the process is, you make the introductions to the relevant parties, and you assist where you can in making a smooth transition, really makes the success of the deal. It saves on time, reduces costs, it gives the parties comfort that the transaction will proceed as planned. So that's really the contents of our substantial presentation. Just like to let you know that you can scan the QR code on the screen and download our Guide to Directors' Duties. Remembering you will have a copy of this webinar if you missed the code. We are having another webinar coming up on Thursday at 11 a.m. Eastern Standard Time, and it's closing the loopholes on law changes and what all employers need to know. So you can register now via our website. I'd just like to take a moment to explain to you LegalVision's desk extension product. Here at LegalVision, we have a solution aimed at busy legal counsel teams that assist to deliver an end-to-end solution really focused on maximising your output by agreeing a scope, making it affordable, providing quality and value aligned services. We're able to produce high volume businesses legal needs. We're effectively partner with you to be your external support to your business. It's cost effective because it creates a larger team to your in-house counsel capability, and we can assist you with managing both your internal and external stakeholder expectations. We also have a privacy compliance solution which not only deals with privacy law, but your privacy practices, provides you with your practical guidance, trains your staff how to assist with your privacy needs and any data breach that may arise. So while everybody is submitting their questions to the chat box, don't forget you can download our guide, or you can contact us anytime via the contact details provided on site.
Yeah, I can see some questions have come through around the tax side of things. So a question that's come through around the GST point is, when is a party actually going to be required to register for GST? So it's a good question, and when an entity is required to be registered for GST, it really comes down to what their turnover is going to be in a particular month. So you have to consider whether in this month and the next 11 months, are you going to make $75,000 in GST turnover or more? Or in this month plus the previous 11 months, have you already hit that threshold? So if that's the case, then depending on the circumstances, factoring in the turnover of the business to date, plus potentially the purchase price, that's where a seller might have to consider registering for GST as part of the deal, even if they haven't had to register up until that point. But it really comes down to a lot of the facts, because your GST-free supplies don't go towards your GST turnover. So that's why actually putting a bit of time to consider whether the supply is one of going concern or not would come down, will, I guess, make a lot of difference as to whether or not that requirement has been satisfied. And there's also been some more questions around the buyer, the implications for the buyer, where they take on a company and there are undischarged superannuation and pay-as-you-go withholding obligations. So we sort of touched on this before when it came to direct penalty notices, but that is a big consideration when taking on a company where it has employees and contractors. So a director penalty notice is usually a tool of last resort that the ATO uses, but they are really ramping up their debt recovery process at the moment, and part of that is issuing a large number of director penalty notices each week. So if there is a company that you've become the director of, potentially they would go after the previous directors, but also could come after you as well for any unpaid pay-as-you-go withholding, superannuation, GST, that kind of thing, that the company hasn't paid. So that's why looking through the employment tax situation of the business is super important, because as an incoming director, that's something that you could personally be on the hook for.
Yeah, very good, Tom. Another great question that's come through, which could be a whole presentation in itself, is if you do conduct due diligence and you find issues, what do you do to protect yourself as the buyer? The first and foremost protection that you want to consider is making a condition of proceeding with the deal that the issue you identify has been rectified. So ensuring there's sufficient conditions precedent in the sale document that will enable you to get comfort that the issue identified has been rectified, whether that's a security interest that you weren't aware of and you later find it needs to be discharged, whether it's a certain license has lapsed, that's essential for the business, they need to reapply before you continue, whether it's a claim that has come to front and it needs to be settled before completion. Any number of things can be found in due diligence, and the first point of call is really making the sale conditional upon that. It's really going to be dependent on how material the issue is. The other ways that you can protect yourself is ensuring that there are specific indemnities in the contract. So whilst warranties protect you against breaches in terms of damages, the indemnities can put you in a far better position, as Tom made specific reference to previously. In the tax section, it also applies to other breaches. So where you're not confident that contractors, for instance, were correctly identified, then having a specific indemnity in there about unpaid superannuation or PAYG, or where you know that there's been a complaint or there's potential employment disputes, then you can have specific indemnities that arise out of any employment disputes, knowing that the Fair Work Ombudsman also has the power to issue fines, not only the unpaid employee entitlement. So it's really focusing on how you can proceed forward, if you can proceed with what you found, and then if you do think you can still proceed, how do you protect yourself when you take over the business that something does come out of it over the other side, and how you're protected. Now, indemnities are only good if you can enforce them. So the other thing to remember is, should a percentage of the purchase price be dependent, therefore, on some sort of earn-out? Is there, if we're at risk that there's been a breach of a major customer contract and that customer might be ready to walk out the door, should we be then tying the purchase price to the fact that the customer doesn't terminate and therefore there'll be a drop in revenue? Should it then be, we'll hold a percentage of the purchase price, as Tom gave the example before, in escrow, or it's deferred in some way until the end of a warranty period? There is many ways that as lawyers we can protect ourselves through the contracts. So due diligence, whilst findings can be threatening or worrisome at the time, there is always solutions in still finding a way to proceed with the sale.
There's just one more that's through around the other potential concessions that are available rather beyond the general 50% discount when selling a business or shares. So again, as David said, that's a webinar in and of itself, but I guess at a super high level, first thing is to think about is, as we said before, any losses that might be available to reduce the gain. But also another big one is whether or not any of the small business CGT concessions might be available to the particular seller. And so those concessions are quite complex, so definitely would recommend getting advice on them. But those concessions, if available, have the potential to either reduce the gain again by another 50%, or depending on certain circumstances, like if the sale happens in connection with the taxpayer's retirement, or if the particular asset has been held for 15 years or more, potentially the gain could be disregarded entirely or disregarded up to a certain amount. So super important that the seller gets advice on the tax implications and potentially the concessions. And Dave also mentioned, when there's an earn-out, and so earn-outs are quite common when it comes to these types of deals. And it's important that advice is gotten on how to structure those earn-outs properly, because depending on how they are structured, they could be treated differently from a tax perspective as well. So the big one is whether they're treated as income or capital, and so there are just different treatments of those types of payments. So it's important that they are structured properly. But yeah, so that's all the time we have for today. So thank you very much for your questions, and sorry that if we haven't been able to get to your question today. So if you are able to submit your details for the next 48 hours, you'll be eligible to receive a free consult to discuss how we can assist with your business. So there'll be a pop-up at the end of the webinar that you can fill out to access that complimentary consultation. And so while this is a free webinar, we really value your feedback. So there'll also be a survey that pops up at the end. So if you could please take 30 seconds to fill that out, that would be greatly appreciated as well. So that's all from us today. Thank you very much for joining us.